Welcome to This Explainer. Okay, I want to kick things off today with a pretty high-stakes question. It's something every single entrepreneur, every business operator absolutely needs to think about. What could possibly cost up to 10 times more than actual tax compliance? Seriously, think about it for a second. You've got the operational overhead, the expensive software, the endless accounting hours. What could literally cost 10 times that entire amount? Well, the answer is non-compliance. According to deep dive expert reports analyzing the modern corporate life cycle, the financial penalty for failing to understand and actually follow tax mechanisms, it is not just a slap on the wrist, it's a catastrophic risk. Look, if you're building a business, ignoring the invisible architecture of regulations early on creates this massive compounding liability. As your business scales, this early negligence scales right along with it, exponentially, eventually costing you anywhere from 3 to 10 times the price of just setting up the compliance properly in the first place. So today in This Explainer, we're unpacking a comprehensive expert analysis on the business tax lifecycle. And we are not just skimming the surface with generic advice here. Instead, we're deeply analyzing the core mechanisms and those hidden cause and effect relationships that govern a corporate entity literally from birth to maturity. We need to frame this not as some boring bureaucratic chore, but as your absolutely most crucial risk mitigation strategy. Here is a quick roadmap of where we're headed. We're going to cover 1, foundations of business identity, 2, direct taxes and fees, 3, mechanics of tax nexus, 4, navigating informational mandates, and finally, 5, essential compliance strategies. Let's jump right into Section 1, Foundations of Business Identity. We're going to look at how this builds the very bedrock of your company. There's this fundamental truth to entity formation. Without a unique 9-digit employer identification number, or EIN, your business is literally invisible to federal tax authorities. You might have a gorgeous, fully functioning website. You might even have clients and revenue rolling in. But until this specific corporate ID number is generated, the structural identity of your business just does not officially exist on a federal level. It is the absolute prerequisite mechanism. You need it for opening a bank account, processing payments, and filing basically any future reports. But here's the thing, identity isn't just about grabbing a number. It is all about transparency. There's this super dangerous implicit assumption out there that business formation is this entirely private, behind closed doors affair. In reality, modern global financial regulatory networks require incredibly strict, mandatory disclosures. You have to thoroughly document the corporate veil. You have to explicitly report the actual living human beings who ultimately benefit from the company. This is known as beneficial ownership reporting. This mechanism exists specifically to prevent financial crimes, meaning your compliance here, it's not a suggestion. It is actively monitored and heavily enforced. Moving on to Section 2, direct taxes and fees. Honestly, this is where a lot of operators make totally fatal analytical errors. There is a massive, massive contrast between income taxes and franchise fees. And here's a totally non-obvious reality that trips people up. A lot of founders rush to incorporate in these so-called business-friendly jurisdictions because, hey, they hear those states have zero corporate income tax. Sounds great, right? But they completely miss the cause and effect relationship of the franchise tax. A franchise fee is not based on your profit. Not at all. It is a recurring flat fee paid simply for the privilege of your entity existing in that jurisdiction. This heavily impacts cash flow, especially for pre-revenue startups. Because even if your revenue is exactly zero, the cost of your corporate existence certainly isn't. All right, Section 3, Mechanics of Tax Nexus. Direct taxes were just step 1. Now we have to turn to the really tricky stuff, indirect liabilities. So, a nexus. What actually is that? It's essentially an official relationship you, either accidentally or intentionally, build with a jurisdiction that suddenly makes you liable to collect and remit taxes there. Now, notice the 2 main triggers here. A physical nexus is pretty obvious, right? You have an office, a warehouse, maybe a local employee located in that state.
Fair enough. But an economic nexus? That is completely invisible. It is triggered purely by crossing a specific sales volume or hitting a certain number of transactions within that region, completely regardless of where your actual physical headquarters is located. And this leads us to a vital expert-level insight that you cannot ignore. Physical presence is simply no longer required to trigger a tax liability. Let me say that again. You could be operating a purely digital software business from a completely different continent. But if you sell enough digital subscriptions to customers located in a specific distant jurisdiction, boom, you trigger an economic nexus. Suddenly, by law, you are legally required to collect indirect taxes from those buyers and remit them. You've just created a highly complex tax exposure without ever setting foot in that region. No way around it. To really highlight the data-driven urgency of this whole situation, I want you to consider this number, 3,000. Expert compliance reports indicate that there can be up to 3,000 regional tax rule changes in a single year across various jurisdictions. Guys, that is roughly 10 rule changes every single day. Different regions tax different digital and physical products at vastly different rates, and these thresholds are incredibly volatile. Relying on a manual spreadsheet to track this mechanism, it is mathematically impossible for a growing business. Let's transition to Section 4, Navigating Informational Mandates. We need to see how all of this applies even when your entity isn't making a single dime. Okay, this right here might just be the most important takeaway of our entire analysis today. Owing zero tax does not equal zero reporting. Because domestic income taxes are fundamentally profit-based, international operators very often falsely project that exact same logic onto federal reporting requirements. They kind of just assume, well, if I have no effectively connected income, I don't have to file anything. This is a highly, highly dangerous myth. It totally misses the core mechanism of regulatory transparency. Federal authorities require annual informational returns to track the structure of your business purely for oversight.
And what happens if you just ignore that informational mandate? The penalty is absolutely staggering. Expert guidelines reveal that simply failing to file these specific informational returns accurately and on time can result in an automatic baseline penalty of $25,000. Just let that sink in for a second. 25 grand. And this penalty isn't even about collecting tax revenue. It is a highly punitive mechanism designed specifically to enforce global financial transparency and aggressively deter things like money laundering. So you could owe absolutely $0 in actual tax, but because you failed to submit a required informational document detailing your corporate structure, you are hit with a catastrophic fine. So, how do we fix this? Section 5, Essential Compliance Strategies. We know the risks, we know the triggers. Let's analyze the essential operational armor required to maintain total compliance. A robust, fully protected business relies on 3 key structural mechanisms. Step 1, you need to open a dedicated business bank account immediately to prevent the commingling of personal and business assets. If you mix funds even once, you pierce the corporate veil and expose your own personal assets to liability. Step 2, connect automated accounting software from day 1. Look, you don't need to check it every single day if your transaction volume is low, but that financial data must be captured continuously. And step 3, maintain a continuous registered agent. This ensures that critical legal notices and those mandatory franchise tax deadlines we talked about are never, ever missed. And this is exactly why leveraging automated tax compliance platforms is just an actionable necessity at this point. Remember those 3,000 annual rule changes? Yeah. Automation is practically the only mechanism capable of continuously tracking those shifting economic thresholds across multiple jurisdictions. It ensures your franchise fees are renewed on time every time, and it actively mitigates the massive risk of multi-jurisdictional audits. Essentially, it takes human error entirely out of a regulatory system that brutally penalizes human error. I want to end this explainer with a provocative question for you to deeply assess. Take a hard look at the architecture of the company you are building right now. Are your business mechanisms built solely to generate revenue,
Or are they robust enough to survive intense regulatory scrutiny and audits? Because understanding the compliance continuum isn't just about, blindly following bureaucratic rules. It is about actively protecting the value you are working so incredibly hard to create. Evaluate your infrastructure today before the regulatory environment decides to evaluate it for you. Thank you so much for joining me on this deep dive.